From Carr, Riggs, and Ingram, this is It Figures, the CRI podcast, an accounting, advisory, and industry-focused podcast for business and organization leaders, entrepreneurs, and anyone who is looking to go beyond the status quo.
I'm Doug Mims. I'm a financial institutions partner in the Atlanta office of Carr, Riggs, and Ingram. And I'm here today to speak with Chris Kane from our Birmingham office regarding the FDICIA, the FDIC Improvement Act. And with that, I will let Chris introduce himself and his subject.
Yeah, thanks, Doug. Hello, everyone. It's Chris Kane. I'm a financial institution partner in the Birmingham office. It's great to be with you. And we have an important topic today to discuss, which is the Federal Deposit Insurance Corporation Improvement Act, commonly known as FDICIA, that was implemented in 1991 by Congress. And the reason for that was the savings and loan crisis during the 1980s. In the 80s, there was a lot of bank failures, and because of that, Congress enacted FDICIA to respond to those issues. And then part of those requirements, the FDIC has laid out in Part 363 of FDIC's laws and regulations.
So, Chris, obviously the FDIC Improvement Act was passed in response to the S&L crisis. And gosh, I can remember, been around a while, but I can remember the FDICIA guide that was issued that we used back in 1991 when we were doing bank audits. But why is FDICIA still top of mind? Why is it relevant? Why is it important for our listeners?
Yeah, absolutely. I've been working with financial institutions 20 years, so been dealing with a lot of institutions with FDICIA. And I think why it's really relevant right now is, as you know, there have been a lot of bank mergers and acquisitions. So because of that, banks have grown in asset size, so they may not be familiar with these requirements. Also, I think bankers sometimes don't understand all the requirements or the complexity of FDICIA. So I think that's why it's relevant today. And clearly, I have clients that still have issues with complying with the requirements.
Okay. So there's two thresholds to the FDIC Improvement Act and the 363 requirements. There's the $500 million threshold, and then there's the billion. So maybe we talk about first, what are the key aspects of the requirements for banks that are over $500 million but under $1 billion in assets?
Yeah, absolutely. And I think too, before we go into those requirements, let's talk about what's the measurement point? Because I get that question from my clients quite a bit. What is the measurement point for the total assets? So what I like to say for a fiscal year financial institution that's also a calendar year, you would start by looking at your 12/31, your year-end call report. And generally that would be your beginning of year for your fiscal year total assets. So the measurement point is the beginning of year total assets, and that is what drives FDICIA. So let's talk about, now that we've determined the measurement point, let's talk about the $500 million and the $1 billion requirements and kind of compare and contrast those. So at the $500 million threshold, the majority of the audit committee members must be independent of management. So those are outside directors. At the $1 billion threshold, all of the audit committee members must be independent of management or outside directors. Also at the $500 million threshold, bank management, that's generally the CEO and CFO, or could be the chief accounting officer, is required to provide a statement of responsibilities for preparing the financial statements and establishing an appropriate internal control structure, as well as complying with designated laws and regulations. Those designated laws and regulations pertain really to insider loans, Reg O is what it's commonly referred to, as well as dividend restrictions. Also at the $500 million threshold, the external audit firm must be independent with regard to the AICPA independent standards, as well as the Securities and Exchange Commission, or the SEC, as well as the PCAOB, and that's something that we see financial institutions sometimes not understand and need to discuss with their external auditors. So one issue that we see here is for a $500 million institution, your external audit firm may be preparing your financial statements as well as the tax accrual. And under SEC, PCAOB standards, independent standards, which are more restrictive, you cannot provide those services. So it's really important to have the bank and the bank management team discuss and monitor the asset size to ensure they get with the external audit firm. So
as a point of clarification for the listener, the independence rules under the FDIC Improvement Act in Part 363, they say follow the most restrictive guidance.
That's correct.
And so when you look at that, then the most restrictive guidance typically is going to be your public company guidance. And that's the PCAOB reference and SEC reference in the description.
Absolutely.
Okay.
So let's talk a little bit about now the $1 billion threshold. And as I mentioned earlier, all of the audit committee members must be independent of management. Still, bank management, the CEO and CFO is required to provide a statement. But here, not only are they required to provide a statement, but they also must make an assessment of the effectiveness of internal controls over financial reporting, ICFR, as of the fiscal year end. So that's something different at the $1 billion threshold, as well as the independent auditors, the external auditors, must issue a report on internal controls over financial reporting and also must still comply with the independent standards, as you mentioned earlier.
So when you're comparing, if you're over $500 million and as you approach the $1 billion mark, the first threshold, if you will, is now your whole audit committee has to be independent. You can't have anybody that's a member of bank management on the audit committee, correct?
That's correct.
And then the other statements of responsibility regarding financial statements and compliance with designated laws and regs, that remains the same.
Absolutely.
But the big difference being you now have to attest to the effectiveness of your ICFR, and you have to have your accountants provide an opinion on that.
Absolutely.
So when you look at when you've worked with banks that are over $1 billion, what are some of the challenges that they face as they approach that $1 billion mark that maybe they didn't have as a bank, a $750 million bank?
Yeah, so that's a really good question, Doug, and one that I get frequently from bankers. And the first thing I say is monitor your asset size, because bankers tend to underestimate the amount of time to implement FDICIA, because it doesn't take months. It can take a year or two is what we tell our clients for implementation. So monitoring asset size is important. Also, it's really important to develop an action plan with key benchmarks, deadlines, as well as get the external auditor involved earlier in the process, as well as schedule a meeting with the audit committee to discuss the requirements, because sometimes audit committees may not know the requirements. And then communication. As we all know, communication is really important in banks and also really important for a successful FDICIA implementation. So all business owners, stakeholders need to get buy-in. So we recommend having a meeting with those folks and get their buy-in and get them on board early in the process to ensure an effective implementation. And then also to understand that controls may not be effective when you first test them. And that's something that I know my clients have struggled with as part of implementation. And we like to say that, probably as many as 25% of the controls may not be effective the first time. And I think the reason, Doug, for that is the error rates. If we were to select a sample of 30, the bank could have one error in 30, but no more, which is darn near perfect. So I know when I'm talking to bankers and they say, hey, we did really well, we had 2 or 3 errors out of 30, well, in this world you failed. So I just understand that controls may not be effective and require remediation, and that can be time consuming. And then also ask for assistance of a third-party professional services firm, very much like Carr, and Ingram. Ask for help. We have templates and action plans that we've used in helping a number of financial institutions. So we'd love the opportunity to help bankers with FDICIA implementation. So thanks so much.
Okay, Chris, well, thank you today for giving us an overview of FDICIA. And obviously, CRI stands ready to help both our clients and prospects. So thank you all for joining us today.
If you want more CRI insights or are interested in learning about our firm, please visit our website at cricpa.com. Thanks for listening to this episode of It Figures, the CRI podcast. You can subscribe to It Figures on iTunes, Spotify, or wherever you prefer to listen to your podcasts. If you liked what you heard today, please leave us a review.